Distinguished ladies and gentlemen, fellow traders, and esteemed participants, today we gather here to explore the intricate weave of high-frequency trading, volumes, and liquidity, and their impact on the cryptocurrency market, specifically focusing on Ethereum (ETH) to USDT. We'll also be discussing the role of market making in this matrix and the pivotal role that meta_quant plays in deciphering these complexities. In the world of finance, change is the only constant. It is, therefore, imperative to comprehend the nuances of cutting-edge strategies and technologies, such as high-frequency trading, also known as HFT, in order to stay ahead of the curve. As we dig deeper into HFT, we'll discover how it stands as the backbone of modern trading, offering numerous benefits such as heightened market liquidity, improved price discovery, and reduced trading costs, all crucial elements in the trading of cryptocurrencies like ETH to USDT. HFT, with its advanced algorithms and high-speed trade execution, gives us the ability to harness fleeting opportunities in the volatile crypto landscape. When applied to a pair like ETH/USDT, it can provide substantial rewards by exploiting minute price discrepancies that occur in microseconds. Volume, in essence, is the lifeblood of any financial market. In cryptocurrency trading, the volume of ETH/USDT represents the total number of coins traded within a specific time frame. High trading volumes often indicate strong investor interest and are a sign of liquidity. High liquidity, in turn, ensures the stability of the ETH/USDT market and allows traders to buy or sell large quantities without causing a significant price impact. Next in our web of understanding is the critical role of market making. By continuously offering to buy and sell securities, market makers ensure that there's always a two-sided market, thereby providing liquidity and facilitating trade even when there's a temporary imbalance between supply and demand. Their pivotal role is even more crucial in crypto markets, where price volatility is significantly high. This brings us to meta_quant. Meta_quant is a state-of-the-art, AI-powered platform designed to decode the complex world of high-frequency trading. Whether you are a seasoned trader or a newcomer, meta_quant's unique features will enable you to cut through the noise and make sense of the intricacies of HFT, volumes, and liquidity in the ETH/USDT market. Its intelligent algorithms can assist in identifying trading signals, executing trades at light speed, and understanding the impact of market making on the ETH/USDT pair. By leveraging meta_quant, traders can better comprehend and navigate the intriguing dance between HFT, volumes, and liquidity, and make more informed trading decisions. Meta_quant helps you understand the story being told by the market, interpreting subtle signals that could potentially lead to profitable trades. This innovative platform is your trusted companion, guiding you through the volatile currents of the crypto market. In conclusion, understanding the symbiotic relationship between HFT, volumes, and liquidity, and the critical role of market making, is integral to thriving in the cryptocurrency trading environment. By harnessing the power of meta_quant, you can unlock new possibilities, improve your trading strategies, and venture into new trading horizons. Remember, in the world of trading, knowledge is power, and meta_quant is here to empower you. Thank you, and may the trades be in your favor. Ladies and gentlemen, let's take a moment to understand the beating heart of today's stock market, high-frequency trading, with a special focus on strategies involving fade logic. For those stepping into this realm for the first time, high-frequency trading, fondly known as HFT, is a cutting-edge trading approach that leverages advanced algorithms to initiate countless trades in mere microseconds. Fasten your seatbelts as we're about to take a deep dive into this riveting world. We begin our journey by exploring a powerful weapon in the HFT arsenal, the use of fade logic. This ingenious strategy, time and again, has proven its worth in over 70% of trading scenarios, acting as a trusty ally to traders in the choppy seas of stock market volatility. Our mission today is to dissect 4 distinct HFT signals based on fade logic, to fully equip you with the knowledge you need to enhance your scalping strategies. As we set sail, remember this: the strategic dance of high-frequency traders and the subtle art of market-making manipulations are the main characters of this drama. Your success will hinge on your ability to perceive and interpret their intricate interactions. With these insights, you will be able to better navigate the choppy waters of each HFT signal. Now, let's turn our attention to our first protagonist, HFT signal 1, or S1 for short. This signal harmonizes fade logic with the rhythm of market making. It's a binary dance that has 2 key steps: the HFT buy signal 1 and the HFT sell signal 1. Imagine this: a trader initiates a sell event. The price starts to decline. The size of the trade event escalates, becoming greater than X. Meanwhile, the market making is humming a positive tune. This, my friends, is HFT buy signal 1 in action. Its counterpart, HFT sell signal 1, materializes when a buy-side trade event occurs, coupled with an increase in price, a trade event size swelling beyond X, and a negative market making. Each signal, a different dance move, yet perfectly orchestrated. Our journey continues with HFT signal 2, or S2, a unique blend of fade logic and the intriguing phenomenon of post-iceberg rejection. This strategy also offers 2 distinct steps: HFT buy signal 2, or the buy iceberg, and HFT sell signal 2, dubbed the sell iceberg. Picture a buy iceberg event: a sell-side trade event is set into motion. The price ebbs. The size of the trade event swells beyond X. Simultaneously, the size of this trade event overshadows the size of the best bid in the order book. A sell iceberg, on the other hand, emerges with a buy-side trade event, a rising tide of price, a trade event size that surpasses X, and a trade event size that outweighs the best ask in the order book. Each strategy, a unique performance, choreographed to perfection. Next on our tour is HFT signal 3, also known as S3, an elegant fusion of fade logic and execution manipulation. Much like its predecessors, S3 comprises 2 vital components: HFT buy signal 3 and HFT sell signal 3. In the case of HFT buy signal 3, a sell-side trade event takes place, the size of the trade event escalates beyond X, and the resulting price impact of the trade event creates a positive ripple. In contrast, HFT sell signal 3 emerges when a buy-side trade event occurs. The size of the trade event grows larger than X, and the price impact of the trade event creates a negative wave. Finally, we reach the crux of our journey, HFT signal 4, also known as S4. This is where fade logic marries the phenomenon of size increases. S4 comprises HFT buy signal 4 and HFT sell signal 4. In the case of HFT buy signal 4, a sell-side trade event is initiated, there's a positive or zero market making, and an intriguing event occurs: there's a price drop despite a size increase in the trade event. Conversely, HFT sell signal 4 involves a buy-side trade event. A positive or equal to zero market making, and an unexpected twist, a price hike despite a size increase in the trade event. Now, equipped with these strategies, what lies ahead? These strategies, fine-tuned and statistically verified, have the potential to yield significant profits by leveraging the temporary price discrepancies in the stock market. But remember, as with any trading strategies, they come with their own set of risks. These require a deep understanding of market dynamics, the finesse of computer algorithms, and the backing of sophisticated trading software. Moreover, the right use of tools like the HFT signals tape, triggers, filters, and auto-trading functionalities can significantly enhance these strategies. However, remember, this is not a guarantee for success. It should always be coupled with a solid risk management framework. As we conclude our journey, it's essential to remember that while high-frequency trading can seem thrilling, it's not for everyone. Always conduct your own due diligence, understand the risks involved, and consider your financial situation and investment objectives before you decide to dive in. That concludes our grand tour of high-frequency trading strategies based on fade logic. If you found this valuable, don't forget to spread the knowledge and continue your journey in the fascinating world of trading. Until our paths cross again, happy trading.